the deal, folks. If you adhere to the strategy of cost average investing into super awesome value stocks with high dividend yields, you have one primary belief today, that we're going to wake up sometime in a year, 2 years, maybe even 3 to 5 years from now in a much better place, meaning the value that exists today is something that you shouldn't let pass by you, and banks are definitely in that category. So today, I'm going to level out for you the Canadian banks from the worst to the best and the ones that I bought today. So ladies and gentlemen, I look so forward to breaking this down for you. Don't let this opportunity pass by you, and let's jump right into this.
Drop it.
What else can't be touched? The banks. I know. Oh, do they look cheap? Holy cow. People come on and say, hey, you want value? It's the banks. Now, I know they got big yields, but this group got shelled today for a reason.
Oh, welcome back, my passive income investors. Like today, we're talking banks. Canadian banks specifically, because there's only three kinds of people that exist. The first kind of person watches the world float by, maybe in utter fear, frozen as they watch the news every night. The second kind of person don't give a and that would be the 16-year-old version of myself that would just, live day by day, not really aware of what was going on. And keep in mind, when I was 16, that was during the 2008 financial crisis. Now, the third kind of person is the person that does actions. That's me, and I'm going to get rich off this pandemic, actually through these Canadian banks, because most people in the investing realm don't have the guts to touch these kind of value stocks. And if there's one thing I've learned from the last crash is when there's blood on the street, as Buffett says, cost average down into that, because you can say I'm making a dumb decision today, but maybe we'll wake up 5 years from now and you might have some serious regrets, ladies and gentlemen. Now, obviously, I'm willing to go down with this ship because this ship kind of represents the Canadian economy, and I'm going to try and be your Sherpa through this utter mess on what banks I'm buying, because I actually just picked some up this morning. Sorry, I'm a little quirky. Slap that like. Just trying to have some fun here today, guys. But let's get right into this, starting with the bottom barrel banks I do not want you to buy, and then we're going to move up to my favorite banks and some that I bought. But let's take a look here, guys, with HSBC Holdings. This is a much smaller bank, highly leveraged. Their PE ratio during this crash is 27, which is something you might want to avoid a little bit. That's pretty terrorizing at a 10% yield. I would not trust this any farther than I can throw a rock, considering their assets and liabilities are even. But again, they've had some okay growth over time. I'm actually kind of shocked at how stable the revenues have been against their earnings. Nonetheless, guys, number dos, we're talking about the National Bank of Canada, NA. Now, this one has actually had some impressive growth since the 2008 financial crisis. Actually, it's probably been one of the best growing banks. A reasonable PE here. Overall, 5.5% yield. So why did I throw at the bottom of the barrel here, guys? Primarily due to the leverage. This bank is a little more leveraged than some that we're going to look at the moment, with $281 billion in assets, minusing those liabilities of $266 billion, leaving them with what? Maybe $14 billion in underlying assets. Taking a look at their growth, we can see they've actually had, pretty decent growth performance. Banks are banks are banks. So this is definitely the better of the junkier banks we're going to be looking at. And the reason I don't like this one as much is because it's a little bit tinier. I like the big boys, ladies and gentlemen. Usually when I buy stocks, I want the best of the best, and we're going to work our way up there. Now, these next few are pretty much all the top tier banks. Obviously talking about things like Bank of Montreal, a favorite amongst the investing community. Not a fan of it, to be honest. It is at the bottom of the list with these guys, primarily due to its very high exposure to the oil sector. It's got a $40 billion market cap. So, if we're comparing it to the National Bank, it's definitely much larger, even a higher dividend yield and a PE of 7. I would be a little more cautious with this guy moving forward, just due to that oil exposure. We don't know what oil prices are going to do. Russia and Saudi just won't give it a break. So I'm still avoiding that sector altogether. Now, here's a bank I do hold. It's not at the top of my list, but I do own it, and I still do buy it. I have a share buyback set up with this guy. And essentially, the Canadian Imperial Bank trades for $35 billion, a 7 PE, and a 7.3% yield. Now, this one's a little lower on the list because if I was investing your money specifically, I wouldn't want to take on... we're trying to top tier the list here, all right, on my own personal opinions. And I love this stock, but it has a lot of exposure to real estate and mortgages. And we know kind of how iffy the real estate market can be sometimes, especially considering what happened in the 2008 financial crisis, usually giving people a little bit more speculation around this guy. And that is also why it has a higher yield. But if we're looking for safety and yield, I'm going to show you the bank that I would rather you pick. But at the same time, I don't mind owning this. I don't have an issue issue essentially with the Canadian real estate market as it stands at the moment. But taking a look with a total asset of $651 billion, it goes above this. We're going to get into the trillions soon here, guys, but still $651 billion minusing these $613 million in liabilities and taking a look at their overall performance, fairly good. Everything on this company is really decent. You know, that underlying asset's about $40 billion, just under $40 billion. So, I mean, they're cruising along, absolutely no problem. Now, the next one is Canada's largest bank, talking about the Royal Bank, and sometimes people think the biggest bank is the best bank, and yeah, to a degree, if you're looking for the most capital exposure, because obviously the bigger the bank, the more money, the safer it is in large amounts, and that's debatable. I mean, go take a look at something like Wells Fargo, of course, but taking a look here, that's the U.S. bank, by the way. I actually don't take a look at it, but taking a look, $119 billion, guys, with a 9 PE. And the reason, again, this is kind of closer to the bottom of the list is it's a lot more premium valued because of the safety and security idea of it. But at a 5.21% dividend yield, I'd have no problem owning this, because now we're getting into the trillion-dollar numbers, ladies and gents, with a 1.428 trillion in assets under management here, guys, with the total liabilities of 1.3 trillion, kind of leaving them, or 1.34 trillion, but either way, leading them fairly close to $100 billion in underlying assets. Pretty beautiful stuff. Now, my top two favorite banks, and I'm going to tell you why this is, and I don't own this one, but we'll start with TD, which I know is a favorite amongst many in the investing realm. And the reason it's a favorite is this is one of the only banks that has the largest amount of exposure, in my opinion, to the U.S., and it actually has one of the best growth cycles behind it as well, which has been incredible over the last decade since the 2008 financial crisis. But sitting on $71 billion, a little more leverage compared to something like the Canadian Imperial Bank, but overall, another very stable, healthy dividend. We go into TD's financials again, taking a look, another $1 trillion market cap, or total assets, I should say, of 1.4 trillion, minusing the liabilities of 1.32. I mean, they're fairly even leveraged with the Royal Bank. But if I had to pick one or the other, obviously we're going to pick TD. Not only is the dividend yield slightly higher, which is absolutely wonderful, the PE is also slightly lower. So obviously you're getting a better valuation, and in my opinion, a better, broader exposure to different kind of loans, mortgages. I don't know. I like this bank a little bit more, those simple value metrics. Now, finally, at the top of my list, what bank would I choose overall, guys? Well, Bank of Nova Scotia, the bank that I primarily use for my investment accounts, currently paying a 7.09% yield, a 7.4 PE, and a market cap of $61 billion. Taking a look really quickly at the balance sheet before I explain to you why I love this stock so much, we're taking a look at $1 trillion in assets. Well, we got to kind of get down to the ones and zeros here just because it kind of goes down that way. We're looking at 1.086 and 1.015 for the total liability. Minusing that out, that's giving them what, roughly $65 billion in underlying assets as well. And take a look at this performance here, guys. Another bank with some pretty incredible performance. And I really like seeing those underlying stability in those bottom line earnings against that revenue. I really like seeing revenue grow, but I also like seeing, earnings grow, because that means there's more money for them. Dividends, which is the reason I love this bank the most, because against all of the peers we just looked at, this bank pays the highest yield, in my opinion, for the safety you're gonna get. And I mean, I am a guy, when I'm looking at value stocks, I'm primarily only looking for high yields and security in those yields. And the big problem in the financial realm right now, let's look beyond the Canadian banks, like something like a Wells Fargo in the US. The problem with Wells Fargo is it's got a lot of pressure going on, and it's probably going to continue to bleed capital. There's nothing really that great surrounding it in the near term, so you're better off waiting before buying it, which is what I've been doing, because trust me, I am down substantially on that position, as I am with all of my banks. But if I had to advise you what banks to buy, and I know I'm jumping borders here, but if you're looking at Canadian stocks, most U.S. people buy these as well. But again, guys, just take a look here. We're looking at that PE of 7.4. Like, even compare that to something like a Canadian Imperial Bank, it's fairly close. It's up there in, assets with TD, Royal Bank, but it's got a PE level down with like Canadian Imperial Bank and like BMO, but with none of the highest risk exposure that these guys have. Yeah, they have a little bit of exposure to oil, but it's only in like the few percent range. It's nothing massive, whereas I think BMO is like 30% plus or something oil. So, I mean, you're getting all the safety that comes with something like a TD or an RY, some degree, but you're getting that yield. And like I said, when it comes to value stocks, I'm simply a yield chaser, ladies and gents. So I decided to pick up a few shares this morning with some dividends that I got paid out. And I do plan on buying quite a bit more down here because if I can be blunt here, ladies and gentlemen, I can't get over how these assets have performed exceptionally well through multiple crashes over time. Yet when we actually run into, history doesn't repeat, it rhymes, and we're in this kind of black swan event, but you really only believe one of two things. You're going to wake up sometime in the future believing we're going to head back to a normal reality, or you're going to be sitting here in fear, terrorized, not making any decisions until usually it's too late. And then like everybody else, you're jumping on stocks like Nikola guys. A lot of people see the hype and then they buy into the hype. And once everyone's talking about it, typically it's too late. And right now there's a lot of blood on the streets, and these assets are going to be around for a very long time. You really only have to believe a few things here. It might be my young ignorance that I blindly believe that there's going to be a much better future beyond this, but I honestly think most people are going to sit here, they're going to freeze, and they're going to miss this opportunity of a lifetime. And like I said, I'm doing everything I can to buy into this. Young, and I'm very confident that my age won't even matter because we're going to wake up in 3 to 5 years, and you're going to be that guy that missed this opportunity. Now, there's a chance the ship could go down. I'm not going to lie. Everybody knows there's a chance the ship could go down. But I'm telling you right now, if these ships go down, the last thing you're going to be worried about is money, probably real estate. You're going to be more concerned about your life. So I'd love to know what you think in that comment section below. Look, ladies and gentlemen, if you want to build up to the comfortability level of making these riskier decisions within the stock market, I highly recommend heading on over to the passiveincomeeducator.com there, guys, where we got some really in-depth courses on analyzing stocks and reading balance sheets that I would highly recommend. Got a lot of good feedback from it, and they're really cheap. It's a few bucks. You can support me, and you can learn something cool. So I want to know what you think in that comment section below, but slap that like, stay cool, stay awesome, and I'll catch you tomorrow.